And it's good to be back after a week off. Well, it doesn't really feel like a week off, if I'm being totally honest. And I see that folks are already in the chat, so just give me a thumbs up if you can hear me. And I realize there was something I wanted to do before the show started, and I didn't do it. Hang on. I'm going to do it right now. And this is a great way to start off a live show while you guys watch me do something. You have no idea what I'm doing. Doesn't really matter. But here we go. Just take me a second, but it's important. Here we are. Here we go. Noreen, I see that you're on the show live. I've just added you as a moderator. Better late than never. We officially have a moderator to the show, which I think means we've hit it big. This is big time now. So I see all the thumbs up. Thank you. So you better be nice to me, or someone might, silence you for 60 seconds. All right. So I want to start the show. We had a great interview with Michael Kitces. I know many of you watched it. It's on the channel if you didn't. A lot of fun. One of the things he said that got a big reaction during the live show was this idea of how investment fees, and mainly, if you pay an advisor a percentage of your assets under management, say 1%, how that affects the safe withdrawal rate. And you think about it, well, we can do the math here, right? If a 4% is an initial safe withdrawal rate, and you got to give 1%, to your advisor, if that's the fee. I was an English major, but I can do that math. 4 minus 1 is 3. Isn't that doesn't just reduce your withdrawal rate by that amount? And the short answer is not exactly no. It's certainly true if you're starting with 4% on, let's say it's $1 million portfolio, so that's 40 grand. And if you're paying an advisor 1%, well, that's 10 grand. And so that math works out, 4 goes to 1. But it turns out that if you do all of the math and think it through a 30-year retirement, it doesn't actually reduce the starting safe withdrawal rate by a full 1%. Now, let's just first talk conceptually why that is. Remember, with the 4% rule, it's what's called a constant dollar withdrawal strategy. So you use a percentage in year one and multiply that against your portfolio. So let's think about what we're doing. We're taking two things: our portfolio value, let's just assume $1 million, and the safe withdrawal rate, we're going to assume 4%. You just do the math, and there's your withdrawal. But the interesting thing about the constant dollar approach is, after you do that, you throw both of those things out. They become completely irrelevant starting in year 2. You don't ever consider your portfolio value. You don't ever consider that initial starting withdrawal rate. Those are out the window. All you do then is take whatever you took out last year, in this hypothetical, let's say it's 40 grand in year 1, and adjust it for inflation, right? So after year 1, you move away from that percentage of a portfolio approach. That's just in year 1 to kind of get the ball rolling, and then you completely ignore it. And so, particularly if your portfolio balance is going down through retirement, which isn't always the case, but your portfolio balance might be going down, your withdrawals are still going up in nominal dollars, or staying flat on after inflation. But assuming we're having inflation, the actual dollars you're taking out of your portfolio are going up. And so the 1% fee effectively gets multiplied against a smaller and smaller and smaller balance, while the amount you're taking out in dollars, which is what the AUM fee is based on, is going up. Hope that makes sense. So, by the way, the end of this is not, in my view, let's all go pay fees, but just trying to explain it. So Michael had actually written an article, and you can check it out if you just Google, what's the name of it? The Impact of Fees and Investment Costs on Safe Withdrawal Rates. This is all the way back in 2012. It was based on a study that I read eons ago, but he did this this nice chart. Let's see if I can make this a little bigger. Probably not. Well, that didn't work. That's not helpful. Here we go. Yeah, not helpful. We got all this stuff going on right here. Don't know how to get rid of that. Anyway, you can see now, oh, now we got this popping up. It's like the wheels are coming off. Here we go. So the blue line is your account value. The green line is withdrawals. The red line are your investment costs. And so you can see, they take up a big chunk of year one, but a tiny fraction of year 30. I think this was over 30 years. Yeah. Now, of course, you could do this for different scenarios, meaning, this started in 1966, which was one of the worst years to retire. And you can see that as the portfolio crashed at the end. But, you could have just as likely had your portfolio go up sixfold. And so the difference wouldn't look quite as favorable, for fees. And I don't know if he charted that. We'll look. He did not. That's interesting. Maybe an article. In any event, I think the better way to think about it is just make sure it's an expense in your budget. And if you're thinking about hiring an advisor, okay, it's going to be 1%. I've got $1 million. That's 10 grand a year, at least in year one. What it'll be in future years just depends on how the market goes and how much you spend. But it's absolutely an expense, obviously. The thing is it comes out of your account, and you might not even notice it. And it's kind of like, I always wondered, why didn't technology disrupt the real estate market more than it did? We still got high realtors. And not that I'm an expert on any of this, but one of my working theories is it's because the buyer doesn't pay. If there was a rule that said the buyer has to pay their own fees and the seller can't agree to pay any of them, so the buyer's got to pay their 3%, I wonder what the real estate market, the realtor market would look like today. But you've got buyers that don't pay, so why not get a realtor? It's free, and they can do a lot of the work for me. You've got sellers who pay, but they're getting a big check, typically, let's say. So it's the cost of doing business. The same, I think, is true. It's not maybe a perfect analogy, but if investment advisors were not allowed to take money out of your account, they had to bill you, and every quarter, on $1 million, you're paying $2,500 a quarter. You had to write a check or put it on a credit card every single quarter. I think the industry would change dramatically. There's just some things we don't feel as it's coming out of the account, but we just don't feel it the same way as if it's hitting our checking account. So anyway, I don't know why I went off all of that. That's the deal. It doesn't. You don't just subtract the percent of AUM from an initial starting withdrawal rate. But by the way, in the article, he puts it at about 0.5%, which is still huge. It's ginormous, right? So there you go. That was it. That's all I had. Now I can just turn my attention to you guys. All right. I got two different systems. I'm kind of going back and forth. One of the things YouTube does, and it kind of drives me crazy, is they show comments based on what's happening right now, not everything that's happened in the past. And I don't know if there's a way. I don't know if there's a way to change that or not. I've looked and haven't been able to find it. But anyway, it's all good. All right. Oh, one other thing. I've had a lot of questions about whether Savebetter, which we've talked about in the past, is safe. People are nervous about, or some people, about investing, putting money in a CD or a bank account through Savebetter. I've actually reached out to them with a slew of questions, and I will report back to you when I get answers. But I had an idea. So let me just show you this real quick. I may do this myself, but it might be, if you're kind of on the fence, you're not sure, this might be something. So let's say you want, so I used, let's see, what product did I've invested in this one right here, the Patriot Bank, no penalty, $255. One thing you could do is call Patriot Bank. Call them up, say, hey, I see this no penalty at $2.55 being advertised through a company called Savebetter. Is it legit? Ask Patriot Bank, or if you're going to do Sallie Mae, ask them. It's just a thought. Okay. Conscience said, I recently began your book and took the red pill. You have to read the book to understand that. However, I now feel behind at the age of 31. I don't mean to laugh. This I'm sure is a heartfelt comment, but you can understand at my age how I might react to that. With my 401k being at 16 grand and a Roth IRA being 17 grand, do you have any suggestions to get ahead? Well, yeah. The first thing is don't take any shortcuts. It just takes you longer to reach your destination. People get into high risk stuff. They start leveraging. They start options. They think, well, I'll throw 5% at crypto because maybe I'll get lucky. I wouldn't do any of that. I would keep a low cost index fund portfolio. I would not sell a thing in a down market. This is what I would do. I would keep investing, and I would, the real key where you are is continuing to spend less than you make. I know that's like not, maybe I'm Captain Obvious here, but that's what drives the wealth in the long term. Here's the thing that you've got going for you. You may feel like you're behind at 31, but your age is actually the thing you've got going for you. Now, I don't know what your goals are, other things you want to do with your money, when you might want to retire. But, if we assume a traditional retirement age, you've got what, 35 plus years? I mean, you could build a fortune in that time just doing the basics. Put away as much as you can. Obviously, there's always a balance there between, spending today and saving. But, the thing is, compounding is really, really, really slow at first. And then I think it takes about a decade to really get it rolling. And after 20 years, it's moving. And after 30 years, it's just out of control. I'll tell you, you just keep saving and saving and saving. 30, 35 years from now, you could make or lose in the market in a single day what you've got now, right? The problem is there's so many people can't get over that initial hurdle. I did an article called The Flywheel. I think it was on Get Rich Slowly, which is owned by my good friend JD Roth. Yeah, here it is. Hey, there I am. Check this article out, The Flywheel of Wealth and the Importance of Patience. There's JD. I haven't seen that video. Anyway, it was fun to write. I don't know. I'd have to reread it again to see. Sometimes I read old things I wrote and I'm like, oh, that's so stupid. Sometimes I read new things I've written and say, oh, that's so stupid. Anyway, yeah, that's my answer. I hope that's helpful. A lot of thumbs up. Good. Thanks, Justin. Yes, Noreen, I'm last minute. The other thing I realized, I think the systems I use to look at chat filter out a lot of the spam. So I don't see necessarily what you guys see. Anyway. Kyle and Emily, do microcaps have a place in a portfolio or not worth the price? Can't seem to find a low-cost index one. That's a great question. And it reminds me of something else I wanted to tell you. So on Wednesday at noon, I'm having Paul Merriman on the show. So if you can join that live, great. If not, check it out later. I've known Paul for years. And he's, as you know, he's very much a fan of, as am I, small cap value. I don't know if he goes micro cap. I'll have to ask him. And then let's see, on the let me make sure I get the date right. On the 24th at 3 p.m., I'm interviewing Ben Miller, who's the CEO of Fundrise. I can't tell you how many people have emailed me about Fundrise. I've never invested with them. I thought, well, I'll do all this research. And I thought, nah, I just reached out to Fundrise. Said, hey, do you mind, can Ben come on the show? And they said, yes. All right. I wonder if, does DFA have, probably not, micro, let me see if I can find one. So they have, yeah, so they have a mutual fund. I'll show it to you. But that, I think, would require buying it through an advisor, I think. I know you can get their ETFs, directly. Here it is. This may not help you if you have to buy it through an advisor. That's relatively inexpensive. If I wanted a microcap exposure, I don't think 41 basis points would upset me. I think microcap has a chance of helping your portfolio outperform, but of course there's no way to know, right? So that's one. I don't remember, does Avantis have microcap? I don't think so. No, I don't think they do. The problem, microcap is so small, well, obviously, that I just don't know that there are microcap index fund. I don't know other than, here's a great title, the 3 largest microcap ETFs. All right, let's check them out. This will be interesting. I'll show you on the screen here in a second. iShares Microcap ETF. It's 60 basis points. That'd probably be more than I would be interested in spending myself. And before I look at performance, I may have to go to risk, but yeah, let's go to risk. So yeah, it's very volatile, right? You think the S&P 500 is like high teens, maybe. Let's just see what we'll use. We'll use VU. Yeah, 1924, and this microcap is 27. Now, by the way, that doesn't. Remember that what we really care about is not the volatility of any one investment, but rather the volatility of our portfolio. You can actually add a risky, that is volatile investment that actually lowers the overall volatility of your portfolio if it's not highly correlated to all the other assets in your portfolio. Now, I don't know this negative 469 alpha doesn't encourage me, and a pretty low Sharpe ratio. I don't, you'd have to dig into that fund to really know. Let's see. Actually, before we leave it, let's look at the portfolio. I'm curious what the average size is. Market cap, 500 million, which is, to me, obviously that's a lot of money. To you, a lot of money, but that is really tiny. And look, it's in the chart. It's all the way down. It's not even in the grid. All right, what was the other one? FDM. I thought Bridgeway had one. Hang on, we'll look at this first. These are going to probably be expensive. 60, it's not terrible, but let's look at the risk just to compare it. Yeah, 27. And actually, I don't even know if these are index funds or not. Is there a microcap index? I don't know. I'm going to look at one other thing. I don't know how helpful me going through this is. I find it fascinating. Maybe I just need to do some more research. And I could do a video on it. Bridgeway, I thought they had a microcap. Ultra small, that's what they call it. Let's check that out. Bridgeway, I think, I haven't studied them in a long time. I owned some Bridgeway funds back in the day. I might have even owned this, I just can't remember. These are actively managed, as I recall, but I think all in all, pretty good funds. It aims to approximate the total return of a cap-based portfolio 10 index published, I'm reading here, published by the University of Chicago Center, CRSP, Center for Research and Security Prices. So there is an index. They're defined as having a market cap the size of the smallest 10%. Okay, well, there you go. So maybe let's, why can't I find, oh, here we go, BRSIX. Yeah, that sounds so familiar to me. I think I may have owned this at one point. I mean, this would have been eons ago. Yeah, 80. No, that's not the expense. 79. It's not cheap. If I were gonna look into ultra small cap, I would certainly at least look into this fund. 79 basis points doesn't thrill me. And if they're all index funds, which I don't know that they are, but then you just go with the cheapest, I think. Yeah, it's pretty risky. So I personally don't feel a need for that or overexposure to it, right? You do a total market and you've got the same companies in there, or I would think most of them, if not all of them. So Kyle and Emily, I don't know that rambling if that helped at all, but that gives you some ideas of things to investigate. This is a great question from Sonny. He wants to know if, from a tax perspective, it matters whether he goes with index funds at Vanguard or ETFs, and he's specifically focused on VTI and VXUS. VTI is the total stock market, VXUS total international. In Vanguard's case, in my experience, and we're talking about, we're not talking about, we know the issue they had with taxes and some target date funds, but these are different. And if we look at, so we can actually kind of get an idea here. And I'll show you how to do that. I mean, you could go directly to Vanguard, but I'm going to actually use Morningstar. And so here's VTI. If you go to performance and then go to distributions, and the thing you do, so just to explain this for a second. So green is income. In this case, it's a stock fund, so this would be dividends. Light blue and dark blue would be short and long-term capital gains, respectively. But there, as you can see, there haven't been any, at least not in the last 5 years. And then I really wouldn't, I don't know in what circumstances a fund like this would have a return of capital. I can't imagine. But as soon as I say that, it happens, right? So, but if it did, it would be in a nice bright yellow. But the thing is, you can't, these numbers, like if you look at, we'll look at 2021 since we're in the middle of 22. So in 2021, it was $2.93 per share of dividends. That in and of itself tells you nothing. So what I do is look at the last NAV, at the end of the year, so 242. So this is, over 1%, but not much over 1%, right? And that makes sense. That's sort of the dividend yield, whatever it is. It's probably up a tad since the market's down, but yeah, it's 147. So you can get a sense of the kinds of distributions you're going to get, or at least based on history, right? There's no guarantee. Who knows what happens tomorrow? So, but we'll call that. You guys could probably do the math faster than I could. 293 and 242. So I don't know. That's about what the yield is, 1.3, something like that, I'm guessing. So if we go to the mutual fund version, and we do the same thing, so the NAV is different, right? I mean, they're priced differently. I mean, it doesn't matter from an investment perspective, but the per share value is just different. But that is neither here nor there. And by the way, the ETF version, I'm pretty sure the way Vanguard works is it's just a share class of the mutual fund, which is one of the reasons you can convert, and as always, confirm all of this because, for all I know, something's changed. But you can convert mutual fund shares to the ETF shares if you want. By the way, I don't think it can go the other way, though. In any event, So yeah, 142, it's about the same, right? 142 into 116. Whoops. Yeah, that's right. 142 into 116. That looks about the same. I mean, you get out the calculator and do the math. So my hunch is, Sonny, all of that to say, oh, I realize you can't all see everything. Sorry about that. I don't think it makes a difference. I can tell you I own the mutual fund versions. I don't own the mutual fund versions. Yeah, I own VTSAX. I've thought, by the way, though, of converting to ETFs, but for different reasons. With those kinds of funds, I personally wouldn't have any concern. But that doesn't mean something could, generally ETFs are the safer bet. And keep in mind that what we've been talking about relates specifically to these funds in Vanguard. It can be different with other companies. I see other index funds. If we go to, what's the Fidelity S&P 500? I always forget the tickers. FXAIX. How could I forget that? FXAIX. So this is Fidelity's 500 S&P 500 index fund. It has shown some capital gains distributions. They may be off the chart now. No, they're not. Look, see, right here, 2018, 2019. Now, are they done? Maybe. I don't know. Now, hold that thought. Fidelity, SP 500. I have this feeling that one day I'll be doing this and I'll be going along, just doing my own thing, answering your question for like 15 minutes. And then I'll look up and the stream has stopped and it's been turned off. Anyway. Or you guys have just all left. That's not right, is it? Let's see. No, that's not what I want. Does Fidelity, it's got to have an S&P 500 index fund, right? ETF. Weird. Why can't I find it? Does anyone know the ticker? Maybe they don't. Fidelity, S&P 500. Well, I don't know. I'm not going to spend any more time. The point is, not all index funds are created equal. And that's true, as we saw, particularly with taxes. Okay. Josh, honestly, I can't remember if I read it or not. I read so much, maybe it didn't make an impression. Landscape report. I hate that they make you put your email in to get the report. I think I read the cover article to it. And I think my quick reaction to it was, here, I'll show you what I'm looking at. This was an article covering it, and I did read this. Let me pull the comment off the screen for you. And my view of this is, and I don't remember how they structured this, but people will say, for example, stocks and bonds are both down this year. To me, that's just almost totally irrelevant. It doesn't feel irrelevant when we're living through it. But what the correlation is in short periods of time is not all that interesting to me. And some would argue differently. Some would say, no. That's exactly why we have bonds, so that we don't, go down, with our stocks at the same time. Well, I suppose, but, at the same time, what's happened this year is, an extremely rare event. And I just generally don't find the idea that because it happened, the 60-40 portfolio is broken or diversification is broken. Every great once in a while, this happens. Something like this happens. It's just kind of the way it goes. But all of that to say, Josh, I have not read it in enough detail to give any sort of meaningful comment. I will, though. I'll make sure I get it. All right. Steven says Guyton would be a great guest. Yeah, I agree, and I'll reach out to him. I do plan, by the way, to do a review of the Guyton Klinger withdrawal strategy. Which, so to me, the absolute best withdrawal strategy is one where your withdrawal rate is so low, at least based on historical data, you'll never run out of money. So think 3.5%. But of course, that's not doable for everyone. And or it's doable, but at great sacrifice. And so it's like, do we really want to do that? But if that's not possible or feasible, or just you don't want to go that route, I think some version of the Guyton Klinger withdrawal strategy, at least to me, makes the most sense. Constant dollar. I know we talk about the 4% rule a lot, and I think it's useful from a conceptual and sort of planning perspective. But I think it's really a horrible way to actually think about distributions. I mean, we just don't spend the same after inflation amount of money every year in retirement. And by blindly taking an inflation adjustment every year, regardless of inflation, regardless of your portfolio, it forces you into a very low starting percentage. And that's really when you want to spend more money in retirement. You're going to spend more in your 60s and 70s than you will your 80s and 90s. I also don't like most of the, percentage approaches. I did a review of the dynamic variable, the Boglehead. It's not really the Bogleheads, but it came from a posting on the Bogleheads. And I think that can work for some people, but the variability from year to year is just, I think, very difficult to manage. Guyton Klinger just makes all kinds of sense to me because, you start with a percentage, you adjust for inflation if you need to. You don't have to, right? But you have those guardrails, and you actually have a couple. And we talked, Michael and Kitsis and I talked about this in the interview. You have two different really layers of guardrails. So they keep you from overspending in two ways. They keep you from underspending. And that just kind of appeals to me. So I'm going to do a video on that. I think maybe this week. Okay. Marty, very interesting article about bond fund investing from yesterday's newsletter. Can you expand on yields versus bond fund value? Well, I think I know the article you're talking about. You say, well, Rob, you just put it in your newsletter. Yeah, I read a lot. I don't know if this was the exact way that the article explained it. But when we think about bonds, like this year is a perfect example. Values have gone down, right? Because rates went up. So if we look at BND, it's lost like 10%. 9 something, I think. Let's take a look. Here it is. Performance. 8.7. So there it is. Lost 8.7% according to Morningstar. But the point of the article is saying, look, it's doing that because rates are going up, and therefore the value of existing bonds go down. But there's a silver lining. Yields are going up; they're going higher, and that will eventually benefit a bond fund, right? Because they're constantly buying and selling. I mean, BND probably owns 10 to 15,000 bonds. Let's take a look-see. Bond holding 17,000, right? I mean, they're constantly, buying and selling to maintain. Well, they follow an index, but to maintain their duration, maturity of the bonds. And so, they're losing money because the value of bonds are going down. That's what's happening now. But over time, they're going to end up getting that money back, so to speak, from higher yields. And it's really, at the end of the day, it's those yields are going to drive the long-term value of a bond fund. That was the point of the article. So don't stress over the fact that B&D or bond funds generally are down this year. And there's actually a mathematical formula that I've studied in the past, not the math of it, just the concept of it. But the idea, and this is going off memory, so I think I've got this right. It's going to be close. That the fund will make up that loss over a period of time roughly equal to its duration. So B&D's got a duration of what, 6.7 years. Now, of course, all kinds of crazy things could happen with interest rates, right? So, they could tank again, and values would go back up. So, it's not set in stone. But although if they tanked again, values would go up, but longer term yields would be down, right? So you're kind of losing from one side but gaining the other. It's just the loss happens immediately, the gain happens over time. That makes sense? But as long-term buy and hold investors, I'm okay with that. I wouldn't, we've talked about no penalty CDs, high yield savings accounts, treasuries, brokered CDs. For short-term money, I wouldn't put short-term money in B&D. Like if I needed it, we need money for some kitchen work that we'll spend over the next year. I wouldn't put it in B&D. But for long-term buy and hold investing, I think it's great. So that was sort of the idea behind the article. That was the one, if I remember correctly, I think that was from Vanguard, right? I'll pull the article up. By the way, if you're not subscribed to the newsletter, I don't know what's wrong. Yeah, it was from Vanguard. See, I do remember. I might be slow, but I get there. Here it is. And there's a link below this video to subscribe to the newsletter. So here it is. It's got a cool picture of a container ship. It looks kind of fake, actually, now that I look at it. Anyway, I think that's a Lego. I don't know what that is. Here it is. Interesting, the difference here between income return line at the bottom and total return at the top. Of course, and that was in a rising or a period where rates generally declined, which is kind of interesting. But in any event, it was a good article. Well, I won't comment on what my biggest day loss was because my mother-in-law could be watching. But yes, they can get rather big. Well, I'll go in. I say, honey, guess how much we lost today in the stock market? She's like, I don't want to know. Don't tell me. Don't tell me. And then I'll go in the next day. Guess how much we won today? She's like, and she's good. She goes, it doesn't matter. We're going to lose it tomorrow. Yeah, that's pretty much how it goes. So my moderator is trying to help me out here. So I am, let's see. Well, I'm actually now using a different tool that can do what I just did, put the comments up there. But I am on live chat, but I don't, over here. See, I've got YouTube over here, Restream over here. But even with live chat, it's live. Well, maybe I do get them all. I guess I do. Noreen, you're a keeper. Is this right? At 5:14, people were asking me questions. Is that possible? Does it make you happy that Cathie Wood's fund has crashed so hard? No, well, yes and no. It doesn't make me happy that people have lost money and are suffering. But, I have a certain sort of view of things when it comes to investing. And what she was doing was inconsistent with the way I think the world of investing works, at least long term. And so in some sense, I suppose it confirmed my beliefs. But of course, that being said, what do I know? Maybe her fund will be up 75% over the next year. But no, it doesn't. It doesn't make me happy for the investors, or because of the investors. There's something about, I think we really crave certainty. The collective we, the human race, we like certainty. And we're attracted to other people. I mean, I guess maybe physically too, but I mean intellectually, who come off as confident. But I see people like that differently, I think, maybe than others. When I see an investor confident about things that I don't personally believe they have any right to be confident about, right meaning, based on any sort of intellectual rigor, like Michael Saylor and his view of Bitcoin. There's not an ounce, I've never heard him ever say, but I could be wrong, and mean it. And I kind of view Cathie Woods that way. There's a confidence, at least in the way she communicates, that I don't think is justified. It's like a CEO who never wants to acknowledge that anything is ever going wrong. I don't trust. It's a trust issue. I don't trust it. They may genuinely believe what they're saying, but if they do, then I don't have any confidence or trust in the analysis or their perspective. So I don't know if that makes any sense at all. Okay. So G Branding says they're 30. They have 3 to 5 years in expenses in cash. That's big. So my first question is why? Why that much? They say I invest all my income. It's basically it's a 3-fund portfolio. Every few weeks, I wonder if I should add to the cash to capitalize on a big downturn opportunity. Well, yeah, I mean, and then help. So that for sort of your buy and hold 3-fund, index fund, whatever it is, portfolio, it's just never an approach I've ever taken because, well, first of all, I don't know what would a downturn opportunity look like, and when will it happen? And so many times I think it's going to happen and it doesn't, or I'm not expecting it and it does. You just have to get a lot of things right repeatedly, and I just don't have confidence that I can do that. Now, for my individual stock portfolio, I do hold some cash from time to time, but I'm looking for valuation levels for very specific investments. And honestly, that's not always worked out for me. But I will tell you, usually it's a very, very, very tiny amount of cash. So in other words, it might be, I haven't reinvested the dividends yet over 6 months, that kind of thing. So very small. I just don't have confidence, for me anyway, that would work on a consistent basis. Steve wants to know, when should we have an idea that we have reached a bottom in the S&P 500? Well, I don't know, Steve. It's kind of the same question. Maybe it'll be when everyone thinks it'll never get better. That'd be my best guess. All right. I don't know that I got an interesting comment here from Bill, which I don't think I can put on the screen. Let's see if I can. What time was that? 6:54. I cannot. Apparently, I can only put on the screen comments that were made after the live started. But Bill says, I was surprised when using the Monte Carlo simulation. There is more of a balance at the end, I assume the end of a retirement period, if you withdraw from accounts annually versus monthly. Can this be accurate? I don't know what you mean by more of a balance. Because, and I don't know what tool you're using. If you're using Portfolio Visualizer, the way I usually set it up is to rebalance annually, but maybe I'm misunderstanding your question. So, all right. So Paul says, would be great if you could devote some time to the topic of long-term care policies and covering that expense in retirement. That's a great question. And I'm writing in a note. Here's what I'm planning to do. I'm gonna reach out to Wade Fowl, who I've talked about in the past. He's done a lot of work, wrote a book. I always turn around. I think it's upstairs. I need to bring it down. Anyway, and there's actually two things I want to talk to him about. I'll add long-term care insurance and annuities. What role should annuity? The whole thing about annuities, and in some ways it's long-term care insurance, because I got to believe there's reasonable rules of thumb. You don't have enough for keep in mind that eventually Medicaid kicks in, right? Like for nursing home kind of care. I think in limited circumstances, I believe Medicare might as well, but ultimately it's Medicaid. So you may not have enough money to protect where it makes sense to have long-term care. You could have so much money that it doesn't really matter. And then it's that in between where long-term care insurance might make sense. But I want to see if I can figure out, and I don't know if he'll have rules of thumb, but what that looks like. At what point should we start thinking about long-term care? And at what point should we stop thinking about it? What age should we buy it at? The thing that I've noticed in the policies I've looked at is the coverages are really limited. I mean, you to my knowledge, these aren't policies where they'll pay for your care for the next 30 years if you needed it. They're very limited. But in any event, I think that'd be a good question. I think he's done a lot of work on that, and I know he's done a lot of work on annuities. So that I will do that. I'll reach out to. I've interviewed him in the podcast I used to do years ago. All right. So, Jock Doc, enjoyed Michael Kitz's chat. Any retirement planners you recommend that charge by the hour or by the appointment? More important to that question, he adds, or she, liked Only Murder, which I think is only Murders in the Building. Suggest Still Game, Netflix, Go Buckeyes. OH, Still Game. I don't know that one. I just, I'm caught up. I think there's one more episode of The Old Man. Phenomenal. But thanks for that recommendation. I'll check it out. So, yeah, well, I can show you this. And I want to improve this resource. I've started a list of low-cost financial advisors. And so it's on my site. You could just Google this. Zorro's one, Rick Ferry. I don't know if he's more of, I think, looking at your portfolio. I think I'm going to be on a panel with John. But there's an example. Other lists. So I really want to improve this, but you might get some ideas there. Some of these individuals I don't know. For all of them, you should do your own due diligence. Yeah, that might be helpful. All right. If you know of others, shoot me an email because I'll look at them and add them to the list. DM wants to know, how did you become such an awesome dude? I can only assume he meant that question for someone else. I don't know. Phil wants an update to my Betterment portfolio. Well, sure. I haven't looked at it. I got to find my phone to log in. Hang on. Don't go anywhere. By the way, when I got up, did you see that I have shorts on under, rather than pants on? It's just the shirt. At least I have something on. I mean, I got that going for me. All right. You do have two-factor authentication set up for all your accounts. So I run all the way over there, and apparently I didn't need that. I must have said, trust this computer. Here it is. So for those that don't know, these are all from credit card rewards. I do have more rewards to add to it. And I got an email from someone asking me to sort of go through credit card recommendations, both for rewards and for 0% balance transfer. So I'm going to do a video on that. But that's the account. It's not bad. It's just their standard portfolio. Let me see if I can show it to you. Oh, here we go. Maybe. Yeah, here's the portfolio. I've got drift. I like that they show you this. I don't know when they rebalance. Actually, I do know that. Maybe 3%. Anyway, here we are. There it is. And you can look. These are all the funds we talk about. I didn't pick them, right? I just picked the core portfolio. Isn't that amazing, though, just from credit card rewards? There were some sign-up bonuses in there. And I got another big one coming because I got the Chase Inc. Preferred. And it's got a sign-up bonus. I think it's worth at least $1,000. I don't remember now. I need to figure that out before I do the credit card show. All right. The Pan wants to know, Rob would like to hear about the book about John Quincy Adams. Another book I read spoke very highly of him, and I'm interested in your take since the book is very thick. Yeah, it's upstairs, but I did read it. I'll tell you what impressed me. So I read John Adams a while ago, and in that biography, it doesn't talk a lot about John Quincy, but obviously his son. But he traveled overseas with his father, and so I mean he was a world traveler. I mean he was in France, he was in England, he was in Russia. His presidency, I would probably say, would not be considered successful. There was some chit chat that maybe there was a stolen election. It's just not a topic of conversation in current times. Although I think that conversation probably is now over. But back then, big deal. And Andrew Jackson was not very happy about it, who ended up winning the next term. The interesting thing about John Quincy was that his time after he was president, he went into the House of Representatives, which I think he's the only president to have ever done that. And his time in the House, I think, is generally and rightly so viewed as very successful. And he basically went to battle against slavery. That's what he did. Obviously, this is in I guess we're talking now the 30s, right? So he won in what? 1824, I think. And then Andrew Jackson in 28, I think. I got the numbers right, the dates right. And then he went into the House. It wasn't immediately, but it was shortly thereafter, I think. Anyway, he really did battle with slavery, argued a great case in front of the Supreme Court. Dealing with that had to do, I forget the name of it now. It's a famous case, but where they were trying to ship slaves to the U.S. and they ended up, the slaves, as I remember the story, killed the crew, and there was this legal battle over what was going to happen to them that went to the Supreme Court. John Quincy Adams was one of the lawyers that argued it. So, his time in the House, he was the kind of guy, he wouldn't take crap. If he believed in something, that was it. He was not going to bend for anybody. And that was the kind of person we needed at that time on that issue. All right. It's a good book. So let me pop over here so I can show you some of these comments. Here we go. Well, why is my 401k investment option so limited? Just target date funds and an index fund? Well, my first question would be, if you've got index funds, unless you literally mean just one, what else do you need? But, different plans offer different things. Some of it could be a question of costs that your employer has to pay or doesn't want to pay. I can tell you that one thing you can do is go to your employer, and it's not going to change things overnight. But I did that with the company that I worked for, and it worked It took a year or two, but they did add a lot of good options. But yeah, it can be frustrating. All right. Okay. Jason, in my 401k plan, other than target date funds, I have 3 international index funds, and there they are. I've chosen VTMGX. What do you think of VWILX? Well, I don't know. Vanguard International Growth. Well, here it is. So it's this is not an index fund, right? I don't think. 32 basis points. We can actually pull it up on Vanguard's website. Oops. Here it is. Stop it. Okay. The fund employs an aggressive approach that attempts to capitalize on global economic expansion. For example, an attractive investment opportunity could be a non-US consumer products company, blah, 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 blah. Yeah, so this is not an index fund. And if the name is any indication, it's tilted towards growth. Let's see. It is. So for me, this personally, it may be a great fund, right? I don't know. But for me, I would not choose this kind of fund for my core international. I would want a more balanced fund. I wouldn't want it tilted towards growth or value. I would prefer an index fund. It's cheaper. Now, if I wanted some extra tilt, I might add a fund. In my case, I would tend to always tilt it towards value, not growth. But yeah, this would not be. Oops, let me pull that off there. This wouldn't. Again, I'm not saying it's a bad fund at all. And I know this is. You said this is not the one you chose, but this would not be what I would choose personally. All right. When do you believe CDs are worth the management hassle versus a high yield savings account? Even no penalty CDs are extra accounts to keep track of, which I don't think is worth it for only tens of basis points. Well, so you're probably going to have an extra account no matter what you do. I mean, you may already have a high yield savings account. I had one that at the time was paying 140, by no means the highest. And I moved that money over to the Liberty no penalty CD at 255. To me, that was well worth it, 115 basis points. But, you may already have a higher, a better paying high yield savings account. I agree with you that if it's, 5, 10 basis points, 15 basis points, I'm not going to make a switch for that. I'm just looking at my site. So we're really adding a ton of accounts to this. I'm trying to track just about everything. I'm working on CDs, but for savings accounts, we have a pretty good list. So what I do is this section here tracks the updates. And please ignore it for the moment that they're not in reverse chronological order. I need to talk to my programmer about that. By the way, I'm the programmer. Anyway, this just shows changes. If you come down here, this is in the order of APY. So I think I just added this one. This was not one I'd, let's make sure that the rate is right. I hate when they do this. I'm going to put in a zip code. It's going to belch at this. I'm not going to like it. There we go. Premium savings rate. Yeah, 250. It's pretty good, right? But again, you'd have the same issue, I guess. This would be a separate account that you have to manage. So, it really depends on how much money you've got in there, how long you're going to keep it in there, and what the delta is. Again, I probably wouldn't even move for 25 or 50 basis points, at least for short-term money that I was going to spend. But it seemed to me 115 basis points made it worth it. Now, I could have gone here, right? But I didn't. I don't think I knew about this one. But I probably wouldn't have anyway. But although I can't tell you why. Actually, the APY is 253. I've got the wrong number in there. I'll have to change that. Anyway, so, I mean, there's no right or wrong answer. I certainly, what I don't want to do is jump around from account to account to account to account, chasing every few basis points. That I'm definitely not going to do. And as I think I mentioned, I'm going to be buying some treasuries. Yeah, so Kelly points out there's no state income tax, which depending on your circumstances could be very appealing. The rates are great. Let's see here. See if we can get some data. Of course, I just did this. I was looking at Fidelity to see if they showed the rates. They don't. I mean, they do if you sign in, but yeah, they're pretty attractive. I mean, relative to where we've been. Thanks for your videos. What's a good entry price for the triple Q? I'm trying to get at 100 shares to sell cover calls later. Well, boy, there's so much in that question. I don't know what a good entry price is. I mean, I guess I don't think of it that way. I don't invest in the QQQ. If I did, it would, I guess, depend why I'm investing in it. In my case, it would be part of a long-term buy and hold strategy, and I would probably be dollar cost averaging into it every month or every quarter. I would ignore price. My question for you is why you want to sell covered calls. I know it seems like free money or low risk money, but what will eventually happen if you keep selling covered calls, eventually there'll be a spike beyond the strike price and they'll get called away, and you may not feel like you've lost because you'll have received the premium, you'll get obviously paid the strike price for the shares, but depending on how much they'd gone up, you could easily erase all the premiums you made for 6 or 12 months before that, potentially, assuming they're relatively short-term covered calls. So those are just questions I have for that strategy. But I don't think in terms of a good entry price. And I don't know what that would be. I mean, you can certainly look at valuation metrics. I can get my computer to work. Price earnings have come down. It was a lot higher than that, but still pretty rich by historical standards. Well, I should say pretty rich for me. But I don't know historically. This won't tell us that. There's just there's no real way to answer that question. In effect, you're asking me what the price is going to do in the near term. There's just no way to know. Does a short-term Treasury ETF have tax benefits like VGSH? I don't know. What tax benefits did you have in mind? This is just Vanguard short-term Treasury ETF. It's interesting to look at these two numbers here, because this number is the yield over the last 30 days annualized, and this is the actual yield over the last 12 months. And the reason they're so different is because the yields have gone up significantly from where they were. It's pretty amazing to see those two numbers. But I'm not sure I follow your question, if I'm being totally honest. Any teasers for topics for Paul? Actually, yes, I can do that. Let's see. Well, one question, he's always favored value and small cap value. I want to discuss with him. If you look at the history, they've outperformed significantly. I want to discuss why he thinks that's the case. Why have they outperformed? We're going to talk about his different portfolios that he's constructed over the years, what he thinks are the best funds and ETFs to build those portfolios, how much, I'm looking at, as you can tell, I'm looking at some notes, how much fixed income to add, factors to consider, how to take money out of investments in retirement, what we talk about a lot, dynamic versus a sort of a fixed approach. Building a glide path, which is just a reference to how your stock bond allocation changes over time. Hopefully it doesn't go like this. Yeah. So here you go. By the way, email me any other questions you have for him or for Fundrise in 2 weeks. So, yeah, inflation, I think, is the most significant thing that could affect the 4% rule. This was a discussion I had with Michael Kitces. I'm not sure his response I fully appreciate, because we talk about sequence of risk or sequence of returns risk. And my question was, is it really sequence of inflation the real concern? Because markets go up and down, and they go up and down, and they slowly go up or over time. But a bad market isn't fixed and locked in forever. Eventually, it goes back up. At least it has. Inflation builds upon itself. It's not like we have inflation, then equal amount of deflation, and then inflation, and then we have some prices have gone down from time to time, but by and large they don't. So, like this year, it's at 9%. That kind of gets locked in for all of your retirement, right? But what he said was, he kind of views it all as one and thinks of returns net of inflation. I get that, but that's still not how you adjust the withdrawals. You adjust them by inflation. And the reason the 4% rule is 4% instead of 5.5% or some other number is because of the inflation in the 70s and early 80s. Because of that inflation, the late 60s turned out to be a pretty rough time to retire. And in order to not run out of money during those difficult inflationary periods, you had to start with a really low initial rate, 4%. Now, that does give me some comfort. I'm not saying that we couldn't go through a period of time that's worse than that, but it would have to be pretty bad. And it would certainly have to be a heck of a lot worse than what we've seen so far. I mean, this is nothing compared to the 70s and early 80s. Now, who knows what the future holds? Maybe it'll turn out to be worse. Maybe I'll be doing this show in 10 years. Oh, look at that inflation, 12%. Will I talk like that in 10 years? Maybe. I've started Pilates. It's ugly. It's not pretty. I mean, so I'll just tell you this. So when I started working out because of my back like a decade ago, I was working at this gym, sort of semi-private, and he wanted me to do a pull-up. Well, I mean, it was not happening. So he gets out a resistance band, puts it over the bar. Okay, put your foot in here. So he's helping me. I get my foot in there. Okay, do a pull-up. Not happening. He's got like 3 or 4 bands on there to get my big butt up off, do a pull-up. And he jokes, he goes, at this rate, I'm going to run out of bands. Well, I was reminded of that today in Pilates as the very patient instructor was giving me like, okay, you can't lay your head down on the floor because you don't have the flexibility. All right, well, here's a block. Oh, wait, your foot can't. Okay, here's another block. Well, here's another one. It's like I got all these contraptions around me because I have the flexibility of a 2x4. Anyway. Yeah. So, yeah, I'm aging. I'm trying to slow it down a bit. We'll see. Pilates is phenomenal, though. Basically, it's like an hour of core and mobility. And then you basically crawl out and hope you can get back into your car. All right. By the way, if you want to ask a question, put at Rob Berger if you could. IBTD. I don't know. Is this like, this must be like the bullet shares, but the iShares version. So, let me go to the iShares website. Someone just asked me about these. Well, they're asking me about the bullet shares, but I think it's basically the same thing. Yeah, so the idea of this fund, and bullet shares is the same thing, is it's a fund, but it acts very similar to an individual bond. So this fund is set to basically expire, if you will, at the end of next year. And you get all your money back. I'm pretty sure that's how this one works. Designed to mature like a bond, trade like a stock, combine the defined maturity and regular income distribution characteristics of a bond with transparency and tradability of a stock. I think this can give some folks some comfort. I don't know, the theory behind it is, I think, that you're going to hold it to maturity. You'll get whatever the yield is. What is the yield, by the way? Overview. Why don't I see the yield? Am I missing it? I see this. How about performance and distributions? Nope. Here we go. Oh, here we go. So trading 12, I don't want that. So the SEC yield, so it's 3%. That's not bad. I would probably just personally buy treasuries, would be my approach, but I don't think this is a bad approach. I guess the question really would be, what are you going to use it for? Why are you buying it? Is it part of an overall strategy? By the way, if we go back to this for a moment, how do I see all of their? Close that. Fixed income. Let's just iShare, iBonds. Let's see if we can. Here we go. What I wanted to show you. Yeah. This is sort of their general page on the bonds because they offer a lot more than just that one. And they're probably going to have corporate bonds in here. Yeah, here we go. They got the treasuries. We were looking at IBTD right here, 2023. They have different maturities. As you can see, they've got municipals, investment grade corp, and high yield. So yeah, I mean, I think these are decent funds. I've not had a need for them. This is an interesting question from Randy. Is it better for cumulative returns, I have to think about what that means, to do Roth conversions up to standard deduction yearly, or leave in 401k even if you predict low tax bracket? So a couple of questions. One is, can you do a Roth conversion from your 401k? I would not be allowed to. Now, after I left my job, I could move it to an IRA and convert it. So that's just a question. I don't know what you mean by Roth conversion up to standard deduction. Is your point, I guess your point is the standard deduction would sort of eliminate the income that the conversion triggered. At least I've not heard of it. I've not heard of it looking at it that way. Sometimes I've heard if you're like, you've retired, but you're not getting Social Security, you might do conversions up to, through your 0% tax bracket, potentially, or maybe 10 or 12% tax bracket. And Michael Kitsis and I discussed some of this. I think it more of comparing your marginal tax rate now versus what it would be if you didn't do the conversion, what your marginal tax rate would be when you take the money out. And that can be extremely difficult. It's a guesstimate. I wonder, in thinking about Michael Kitts' conversation, I almost got the sense that he thought it was less of a guesstimate than I do. But maybe I'm reading into that. You can certainly make assumptions and project your tax brackets into the future. New Retirement does that as one example. You don't have to use that tool, but it's one of the things that it does. And my general view is if I'm pretty much the same now as what I think I'll be, as best I can guess, when I'm in retirement, I do the Roth conversion. And I do that. My theory is that, one, I think tax rates are likely to go up for me, for most of us, very unlikely to go down. Not impossible, though. And also, I would be paying the tax out of, from outside the IRA. So my break-even point over time actually gets lower. We talked about that in the interview. It's the break-even tax rate. Vanguard did a study. I've done a video on this. But if you Google BETR, stands for break-even tax rate. I think that's what it stands for. You'll get this from Vanguard, and they have a paper on it. It's worth reading. I'm pretty sure I did a video on it. Sometimes I can't remember if I did a video on it, a separate video, or if it was part of a live stream. But I think I did a separate video. Hang on, let's find out. I did. Well, I talked about it. When a Roth conversion in a down market is a smart move. 2 months ago. Anyway. I don't know if that's helpful. I hope it was. I think Roth conversions are one of the most difficult. In some cases, it's simple. You get a massive bonus this year and your tax rates go sky high, you're not going to convert. Or you take a sabbatical, you take a year off, and you can convert it 0 or 10 or 12%. And your rate's going to be higher than that in retirement. It's easy. Or you've quit your job, you've retired, but you're not getting other income, you're just living off some taxable money. It may be an easy decision. Everything else, I think it's a lot more complicated or a lot more guesswork. I will, Josh. It looks interesting. All right. Well, so Jay says, it sounds as if withdrawal strategies are all based on brokerage accounts. When money has to come out of an after-tax accounts, it would seem that the advice would have to change. I hear Zib about that. Here's the way I think about it. So I've heard some say that, like Bill Bingen said this in my interview of him. He said his analysis is based on retirement accounts. If you use a taxable account, the safe withdrawal rate goes down. Conceptually, that doesn't make any sense to me. The way I prefer to look at it is The withdrawal rate is what it is. And if taking money out triggers taxes, that's just an expense you have to pay. So you got $1 million and you take 40,000 out, and that triggers $5,000 in taxes. It has to come out of your 40 grand. I don't see why it would have to change the withdrawal rate or the strategy. Now, obviously you may decide on which accounts, to take the money out of, and factor that in part based on taxes. But once you've decided what you're going to do, if it triggers taxes, it just has to be paid from what you have for the year, I think. It seems like a simple way to think about it to me, but maybe I'm missing something. See, now this is what a great moderator does. She encourages a thumbs up. Yeah, Jay, I noticed the whole thing about after-tax, pre-tax, but I got your question. I think I answered it. And look at this. She's even promoting the newsletter. This just gets better and better. We've got like 5,500 people that have signed up for the newsletter, I think. Let's take a look-see. 5,528. That's not bad. And a lot of people have signed up today. Maybe some of you. Okay. This is a funny comment. When the S&P 500 hits the bottom, they blow a horn, don't they? Okay. So Joe says, I have heard that if you move to Puerto Rico for half a year, you don't have to pay federal income tax. The island tax is only 4%. Could you go there and liquidate your retirement accounts? Well, I'm actually filming this from Puerto Rico. No, I'm kidding. But I have been to Puerto Rico. Lovely place. I've been there a couple of times. I have a good friend that is from there. There are some tax incentives, or particularly moving a business to Puerto Rico. Individual, I don't know. I'm going to suspect. I unburdened by any knowledge of your specific question, Joe. I'm going to go out on a limb and say there ain't no way in the world Congress is going to allow us retired folk to move to Puerto Rico for 6 months, cash out our retirement, and avoid paying taxes. That's my guess. There are some tax advantages, significant tax advantages, potentially in Puerto Rico. If I'm wrong, please let me know, Joe, because maybe, we'll just all do a collective move to Puerto Rico for 6 months. I don't know if I could talk my wife into that or not. Well, Tam, I see that you didn't finish the comment, but we've talked about Wellington and Wellesley funds before. Wellington is 60-40, I think, right? Wellesley is 40-60. They're actively managed funds by Vanguard. Two of the oldest mutual funds in existence. Wellington might actually be the oldest. I'm not sure. And they've done extremely well. I personally would just stick with index funds. That's just my bias, but they've been great funds. Now they're balanced funds, meaning they own stocks and bonds. So in my mind, they're best suited for retirement accounts. Let's see here. Yeah, look at this. Inception date. July 1st, 1929, right before the market crash. That's exciting. Yeah, been around for a long time. And it's done very well. It's down 11%, but everything's down just about. So, and we can look, I don't know why, this is their website. It's because of this navigation. Anyway, I'll stop belly aching about it. Yeah, so it's 60, well, it's more like 65-35, I guess, right? It stopped working. Anyway, you can see it down here. There it goes. Yeah, roughly 65-35. But they're good funds. I mean, I think they're highly regarded funds. I have no idea what that is. I'm going to Google it. Registers annual Great Bicycle Ride Across Iowa, which is a non-competitive bicycle ride organized by the Des Moines Register. Wow, I'm trying to think of how big Iowa is. I spent a lot of time in North Sioux City, South Dakota, which is right next to Sioux City, Iowa. I was representing Gateway. Well, it was Gateway 2000. And then we got to the year 2000, and they were like, what are we going to do now? We can't be called Gateway 2000 in 2001. So they just changed it to Gateway, and then they're gone now, I think, today. Anyway, I'll have to check it out. That's a new one. That's a new one for me. So this is an important question from Ray. With intermediate and long-term bond funds beaten down so much, would now be a good time to start buying some? So we tend to evaluate things, financial things, it's a technical term, based on recent past. So when we look at like a 17-month no penalty CD that's 2.55, we get, oh, that's pretty good. I mean, just not long ago, you had 50 basis points. And we do the same thing with, at least I think I do, the same thing with stocks and bonds. Stocks are down 10, 15%. So we remember when they were higher, so this seems like a good time to buy, or the same thing with bond funds. But of course, what we don't know is what's going to happen in the future and in the near-term future. So I really don't think about things like these kinds of investments in the sense of now's a good time to buy, 6 months it wasn't, or now's maybe not quite the right time, but if it just goes down a little more. I just don't think of it that way. So I own intermediate term bonds, and I have. That hasn't changed. I've just held them. And if I just keep holding them, I'll do okay. So, I mean, would I prefer to buy stocks and bonds at today's prices than 6 months ago? Sure, right? They're cheaper. But I would not be comfortable to be holding out for some future cheaper price for this kind of investing. It just, if you're buying an individual company, I could see choosing not to buy it right now because you don't think it's a good value. And whether it will ever become a good value or not, you don't know. But for broad-based index funds, I just see them as sort of dollar cost averaging, buy and hold. That's just how I do it. But I think just about any day is a good day to invest. So, yeah. Jay, I'll have to check that out. So by the way, if you haven't seen The Old Man, it's got Jeff Bridges and Lithgow's in it. I mean, they're both phenomenal. But it's terrible, I don't know her name. But the actress that played Maybe on Arrested Development is in it, and she is phenomenal. She keeps up with John Lithgow. I mean, which ain't easy to do. I mean, because I think he's a phenomenal actor. It's a lot of fun. I don't know why I keep bringing these shows up. You know, I did do that. You should have a send in portfolio so you can analyze them anonymously in a live stream. Maybe okay, let's do a poll. I'm going to ask a question. Should I analyze one portfolio, obviously anonymously, each live stream? Is live stream one word or two? I'm gonna keep it as two. I just feel more comfortable as two. I don't know. If my mom's watching, she'll comment and tell me whether I got it right or not. And there, you can vote. Should I analyze one portfolio each live stream? All right. Yeah, the IRMA premiums they get steep. So that account, I would say it's 2.5, maybe. But one thing that helped me was that for a while I had the money invested in Wells Fargo and Bank of America, and they like doubled. They did extremely well, and I ended up deciding to move them. I wanted to try different brokerages. I had them in M1 Finance, and I thought, let's do something different. So let's just throw it into Betterment. And I timed it, not, it sounds like I'm timing the market now. It wasn't on purpose. It was just, I took it out at the right time and had it in cash for a while just because I hadn't gotten around to setting up the Betterment account. Put it into Betterment. So I got kind of lucky there. And there's some sign-up offers in there. But yeah, a couple of years. Yeah, but the stuff grows. I mean, and we do a good job of we don't max out our rewards. We could do better. We'd have to have more credit cards, and I just don't want to bother with it. But when I do the video, maybe I'll try to get as more detailed. Like here's one strategy. You may be familiar with the Citi Custom Cash card, where it's kind of like those rotating category cards, but you don't have to actually sign up for anything. Every month they just look at your highest category expense. There could be some limitations to this, but it includes all the categories you would expect. And they give you 5% on up to $500, right? And that's sort of consistent with the rotating category cards, which are typically 5% on up to $1,500 per quarter. Citi Custom Cash is 5% on $500 every month. Anyway, a lot of couples will each get their own. And they'll use one for, I don't know, restaurants and one for gas or whatever. And it's just a small example, but it helps to accelerate the rewards. Now it's on relatively small dollars, but it all adds up. Then you can get the Rewards Plus card. You get a 10% boost because Citi Custom Cash actually pays thank you points. I mean, you can treat it as cash, but you can get 10% bonus. Although I'm pretty sure Rewards Plus has a fee. So this is an interesting question. Vinyl says, you realize they pay these bonuses out of the money they make from people who carry huge balances. Well, I would think of it a little differently because they're getting fees from the merchants, and higher paying rewards cards can have higher fees. So in some ways, we end up paying for it through higher costs, which can get passed to people who don't have rewards cards. But I get your point. And it's an interesting one. My question to you would be, does that make it, this is a question, I'll use the word immoral, it's a strong word, to use rewards credit cards? I don't know. I was a philosophy minor, and that's a tough one. Of course, I'm not sure Aristotle would help me. Maybe he would if I, paid more attention. I had a great professor, phenomenal professor. It's 8:35, but I'm going to keep going just a little bit here. Steven says, I've managed my own funds and recently have shifted to dividend investing and the biggest two funds are SCHD, which I own, by the way, and DGRO. Should I look at others, or what should be the key characteristics? Well, I think the starting point is, what's your plan? What's your stock bond allocation? For your stocks, are you going to have US and international or not? And why not? The why not, the point there is not so much that there's a right or wrong answer, but so that you understand why you're making the decisions you're making, right? Because ultimately my goal is for people to have a recipe, which is all an asset allocation plan is, that they can stomach. You like I did that? Recipe, stomach, huh? And that was live. I mean, no, I'm not slowing down. Anyway, and then for the dividend investing, my question would be why are you focused on dividends? Is this a taxable account, retirement account? Again, these are all questions. I'm not suggesting there are right or wrong answers, but I think you have to answer those first before you can even begin to think about what funds, how many, should you add more? I don't know what DGRO is. Let me look that up. So like one question would be, so this is iShares core dividend growth. So these are both, from what I can tell, I own the Schwab fund. These are both good funds. My hunch is, I would think there'd be a lot of overlap. Let's see. I could be wrong. Well, not a ton actually. According to this tool, only 27% overlap. That's interesting. But in any event, so to me, those are the questions, among I'm sure many others, that you ought to think about. And then to me, I like to implement the plan with as few funds as I reasonably can. Again, no right or wrong answer, but the fewer funds you have, it's just easier to maintain. Look at this, my mom. Hey, Mom, love you too. She didn't say anything about live stream versus live stream. She will. It's probably later in the chat. Did my screen freeze? Hope not. All right. Yep, I've seen those. SoFi or Wealthfront is 2%. I think I have that on my. I should have that on my site. Let's see. Yep. So here I got Wealthfront. This is just checking for me. I got the 2% APY. I got that right. SoFi 180. Good. All right. I really do. Keep sending me. If you know of accounts that you think I should include, please send them to me. My goal is to have. I don't necessarily want every bank in the country. First of all, there's like 3,000 or 4,000 of them, and that's just FDIC. Then there's credit unions. But I certainly want all of the high-paying ones. I'm also starting to collect and publish banks that offer bonuses. The best bonus is probably from Citibank in terms of the amount of. It's a 15. Well, no, they now have one that's $2,000 bonus. Now, I think you got to put 300 grand in the bank. But still, if you got it, let me see. I'll show you that. I'm working on the bank bonus page. It's kind of a mess right now. I was working on it today. So what I used to do, not that you really care, I do things like this. Some of these are out of date. Look at that expiration. That's terrible. That's embarrassing. That'll be gone this week. But this is what it's going to go to, something like this. And actually, I thought this one was now 2,000. It is. So I got to change that bonus amount to 2,000. But this is, so, here it'll tell you the bank, the name of the account, the type, which is sometimes obvious from the name, sometimes it's not, the potential bonus amount, and then details. Yeah, that's the biggest bonus. But I've got a ton of work to do. There's a ton of bonuses I don't have. But I'm working on it. So if you know of any good ones, let me know. This is an interesting question, John, that I've gotten a lot. And I don't quite, it's like I feel like I'm missing something. Is it okay to have VTI in a Roth and individual account? I assume by that you mean like a brokerage account. Yeah, I don't know. I'm trying to think why that would be an issue. I've had a number of people ask me a variation of that question. Is it, I'm trying to think, well, okay. If you wanted to sell something in a taxable account at a loss to harvest your losses, you got to make sure you don't buy it within 30 days of that loss sale. It could be 30 days before you sold or 30 days after. It's really a 60-day window. And you can't buy it anywhere, not just the account you sold it in. You can't buy it in any of your accounts. So if you're over and if you've got a Roth IRA and you sold VTI at a loss in your individual account and went over and bought it in an IRA or 401, that's a problem, right? So I could see if you decided to do some tax loss harvesting, though, you could simply buy a different, like you could go from a VTI to an S&P 500, let's say, or an SCHD, right? And then if you wanted to, move back to VTI after the wash sale period is over, if that's what you wanted to do. Of course, depending on what the market did, you might have short-term gains, so you may or may not want to do that. But I mean, putting tax loss harvesting aside, because that's not really your question, I can't see, no, I don't think there's any issue at all. And so, I don't know, am I missing something? I guess my question to you would be, what's your concern? Like, what's triggered this question? Thanks, Brian. I'm pretty sure I've got that one. It's interesting to me. I thought maybe it had even been a little higher, but maybe not. Oh, yeah, it's 140. Yeah. It's interesting to me that banks like Amex are at 140. And if you go to like Marcus, what's Marcus? It's probably the same, 150. But there are plenty of banks that are much higher, like we've seen. SoFi, 180. UFB Direct is 181. And I think it's going up tomorrow. Yeah, I think UFB is going up tomorrow. CIT is 190. TAB, 192. I think with banks like Amex and Ally, they're 160. And Marcus, Discover is 150. They have such brand recognition that they can get away with lower rates because people feel comfortable. It's kind of like the Savebetter. They're new, and I get it. It's like, no, I'm not sure. But Amex, come on, it's Amex. Marcus, it's Goldman Sachs. I feel safe. They're all FDIC insured, but I feel safe. Yeah, I get it. Yeah. By the way, I don't bank at any of those places. Well, so back to this Treasury ETF, I'm going to assume you don't have to pay state and local income tax, but that's just an assumption. I mean, if it holds treasuries, you shouldn't have to, but I don't actually know that. It's like, because it's packaged in an ETF, are Treasury ETFs subject to state income tax? Because U.S. Treasuries are tax-free at the state and local level, interest payments from sovereign bond ETFs that hold U.S. Treasuries are also exempt. That's not really what I wanted. If you own a bond mutual fund or ETF, you'll need to calculate the amount of income you earn from the fund's government bond holdings, if any, in order to take advantage of this exemption when you file your taxes. And that's from Vanguard. So there you go. It's right here. I was reading from this paragraph, and here's the title. So you can just Vanguard and Google that. I mean, it makes sense, but I'm always careful, or try to be, because as soon as you think something makes sense with taxes and investing, you're all wrong. Or maybe that only happens to me. Sure, buying. I'll call it the buying bond video. So that would be sort of individual bonds, and I would be probably focused on government bonds. The whole world of corporate bonds, I've never really gotten into in terms of buying, individual corporate bonds. But I mean, I can walk through it. I mean, the terminology, I can walk through just using treasuries, and I'll be buying some this week, so why not? I'm looking. There's a great book. I need to get all my books down here, called The Bond Book. It's by Anne Thau. Is that her name? I'm sure I'm mispronouncing it. Here it is. Annette Thau, I guess. I don't know. I remember I was applying for a job, and I had to send the resume to someone whose name I couldn't really pronounce, and I didn't know how to address it. Is this person? I didn't know if they were their gender. I didn't know how to address the letter, and so my mom, who is a retired teacher, and she taught English as a second language forever, I knew she would know, and she did, and she was right. All right. Not sure why I told that story. So, and now we learn that our moderator has a sense of humor. Trust me, that's a video you don't want to watch. Actually, maybe it would be my best viewed video. And of course, it'd be comedy. I have no mobility, none. Like if I were to try to the whole touch your toes without bending your knees, I'm probably this far from the ground, reaching down. I got like this much. I could never be an NFL official because I can't really signal touchdown. There'd be no touchdowns or field goals, or I guess I could do a safety. I don't know. Anyway, you see the problem here. I'm working on it. How far would you lean into mid-cap, small-cap if you were 23? What about no-cap? I'm not sure what no-cap is. With no, I don't know what that is. I would tilt towards small-cap value. That's what I've typically done. And my allocation there was usually about 10%. Again, I'm not saying that's like the right answer. That's just what I did. And that's what you're asking me. That's how far I would lean into small-cap if I were 23. I would lean in it that way now, too. John, welcome. Oh, that reminds me. Let's go back to it's 8:50. I gotta get up early tomorrow. Not really. I don't, but. So let's look at the poll. 79, so I just chuckle. So 79% of the respondents said, yes, we want you to analyze a portfolio. 21 of you said, yeah, Rob, I don't really think I don't want to hear that. No, thank you. So I guess I could do it 4 out of 5 live streams. I don't know. I'll prepare ahead of time and I'll keep it short. And I'll try to come up with like a lesson learned rather than just here's the portfolio, here are the funds. So we can actually talk about a specific issue. So feel free to send them to me. I just need tickers, account type, meaning taxable or retirement, tickers and percentages, what percent you have in each. I don't need your actual portfolio balance. I'm going to end that poll, and I'm going to ask one more before we leave, before we call it a night. So the question I'm going to ask you is, should I do Investing 101 videos? And what I mean by that is sort of a series over time of very basic, what's a stock, what's a bond, what's asset allocation, what's, maybe one on the different ways to categorize stocks, by market cap and value growth, and how terminology related to bonds. One, I get this question a fair amount. And one of the hurdles to all of this, just becoming comfortable with what you're doing, feeling some confidence, not in a bad way, but not constantly worrying that you're making some terrible mistake, is terminology. Just understanding the concepts behind all of the lingo, I think. But these would be short videos. I can hear the applause now. I guess I'd keep them under 10 minutes probably. And they may not be for you, but maybe I do these and you send them on to someone that you think could use them. I don't know. So there's that poll. If you could answer that one. Roger, I'm going to tell you, pull-ups are a great exercise. And as I told you, I couldn't do one when I was 40. At one point, I could probably do 10 or 15. And these are not, by the way, just to be clear, these are pull-ups. These are not kipping, throwing your feet up to try to, none of that nonsense. These are dead leg pull-ups. Now I'd probably be lucky to do 7, maybe. Part of it is a shoulder issue. This shoulder's it's not my friend right now. It's a good exercise though, good for core. So Matthew says, most authors focus on when funds are needed for, I'm not sure quite what that means, but I think I get this question. Does absolute wealth levels matter also? I don't think so. If I had won the Mega Millions, which I didn't play, but if I had, it would have gone in index funds. I mean, I might have, when you're talking about that kind of wealth, you might invest in other ways, like you might buy whole businesses, for example, or you might invest in ways to, in whatever, better the world in whatever way is meaningful to you, right? That kind of thing. But if I just wanted passive, investments, I would not feel a need to have 35 funds. I don't care if I've got $1 billion. For me, about 5 funds would do it. Okay, so the poll, I'm kind of surprised at this, but I'm kind of glad because these will be fun videos to do. So 74% said yes, 26% said no. By the way, I hope the 26% that said no are not also the same people that don't want me to do a portfolio review, because I could lose a quarter of you guys, and that, I can't afford that. All right, I am going to do some of those videos. I got to think through kind of maybe in order. And I can put it all in I can group them all together over time, so you can just literally go down and do one after another. Again, you may not need them, but maybe you know someone that could help. So, all right, I am going to call it a night because I'm tired. I am not going to go do pull-ups. I'm going to go crash in front of the TV for a bit. So, got a lot going on. Remember, Paul Merriman on Wednesday. Email me questions if you have any. I'll do as many of them as I can. Paul's terrific. Hope you can watch. And Noreen, you've fantastic job. I have no idea who you kicked out of the chat, if anybody, but you were awesome. Thank you. All right, gang. Have a good night. Have a good week. And remember, until next time, the best thing money can buy is financial freedom. Final poll, by the way, on Investing 101 videos, 76 yes. No, 77 yes, 23 no.